interesting rollover and pushback lower. Make it or break it day for the NQ. You know what? I think you're probably right, and we're going to show you a couple of reasons why that might be the case. And it's not just limited to the NQ certainly, but remember the NQ has lifted the entire market. So I started with the ES. We're going to highlight kind of where it's at. Then we're going to go to the NQ. We're going to go to the catalysts that are driving it, and we're going to try to set all this up as we get right into the open. Thank you, David. Good morning. Good morning, James. Good morning, all. So first off, the ES, this is yesterday's price action over here on this left in this sell-off, 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 recover about half. And we recovered specifically to that area, the peak, where we traded up to about an hour, hour and a half after the open. Then we created lower highs and lower lows, lower highs and lower lows. And a lot of people ask me, do you trade the overnight? My answer is yes, if I'm awake. Usually I'm not. But I do think that the overnight is very valuable because we've seen multiple days, multiple weeks where we've had at least 60 to 70% of the total move in overnight trade, which means the European market and the UK are trading the US equity indexes quite aggressively. And we're getting lots of action and key data that's coming out of that. This lower high, lower low, lower high, lower low, right back to the projected 50% or balance. Think of this as the fair price projected forward. That should end up matching with point of control. And so that's what we're seeing going on now. So here we are bouncing in at this point of control and kind of holding here. Now, this little dotted line is not a moving average. It's the volume weighted average price. And you can see that we're just kind of riding down lower and lower and lower. This is not a strong resistance area, in my opinion, from the intraday view. A VWAP is generally a magnet and a bias. So the fact that we're maintaining a downtrend and most of the time closing below there, it doesn't matter if it's testing it, we're keeping that pressure onto the downside and settling in close to that balanced price. So right now, I read this as the market is saying this is where we're supposed to be. Yesterday's lows, in essence, overnight lows, fair price, and somewhere near VWAP. So the ES is saying, we've got this. This is where we think, this is what's projected. This is where we're balanced out. So the ES isn't really giving us a ton of pressure one way or the other. As far as right now, it's slightly downtrending, finding support. Okay, fair enough. Or finding balance. Balance. We'll call it balance. But, like you said, the NQ is the one that was rocking and rolling. Now, why was the NQ rocking and rolling? Well, because of Palo Alto Networks. And so as we look at the NQ, we start seeing a different story. With the NQ, bigger downtrends, and we started that long before Palo Alto. But look, huge sell-off, pause. Most of yesterday's sell-off was in the overnight. And then we continued that, zooming in now, to get the NQ story. And on the NQ, we did the same thing. We did clear the mid-price at 9, 10 o'clock my time up there, but we created lower highs, lower lows, lower highs, lower lows, and found fair price. Now, I don't have that drawn over on this side, so I can do that really quick. If I draw it on the left-hand side, it's going to tell us on the right-hand side where that fits in with the tick chart. For those of you that are unfamiliar with what I'm doing here on this, the left side is a time-based chart. The right side is a tick or a trade-based chart. And so these candles don't even appear until you get currently 3,200 ticks. As you can see, each trade that we're taking going into this is counting 1, 2, 5, 10 different contracts. So as soon as it gets to 3,200 contracts on the NQ, it gives us a new candle. But we're further away from the volume weighted average price. We're still downtrending, but we're finding fair price down here. So the pressure does seem to be building to the downside and at fair price. So like I said, it could be that break point. Is there anything else we should be paying attention to? Hey, Granny. Good morning, James. As we're looking at this, what else has gone on? What else did we see? Yesterday, we had some other earnings. And again, if anybody took earnings trades and you want to analyze those today, be more than gladly be more than gladly. I would be more than glad to do that. So we'll get to that. But yesterday, Barkin was barking up the wrong tree. Barkin was talking about all the struggles the economy was having, which was interesting. He was trying to couch it in, hey, look, we're doing great. If it weren't for that darn plague that we have. So he talked a lot about productivity metrics missing, and they need to be viewed over longer time periods, saying, hey, we're not getting what we thought. He said the weaker growth overseas shouldn't have much impact on the U.S. recovery because it's driven by domestic consumption. What we saw yesterday in Visa and MasterCard was showing us that U.S. consumption was slowing. And I'm just highlighting a couple of the things that Barkin said yesterday. He said the U.S. still has a ways to go, in quotes. I mean, that's his statement. A ways to go to get a soft landing. The U.S. is on the back end of its inflation problem. But the question is, how much longer will it take? And we talked a little bit about this with Canada inflation. We talked about the global inflation. We talked about Japan. We talked about the UK, both in deflation and disinflation, and deflation in China. So all these countries, when he said, you know, it's more important that the U.S. has consumption, because that's true. The U.S. is actually the largest manufacturer in the world. But it's also the largest consumer. So we consume all of our own stuff and everybody else's. That's why we have a negative $60 to $70 billion a month negative or inverse trade balance. Trade balance being an oxymoron. So a couple of other things that we could be looking at is we're looking at this pressure to the downside and we're watching these drop. Let's go take a look at Palo Alto, just the response that it had. And Palo Alto, I'm assuming you all have probably read some of the information on Palo Alto. And you know that when I look at Palo Alto, or, well, let me restate. When I look at earnings in general, I'm going to give us a little bit more time here. We'll look at yesterday so we can see the overnight. When we look at a company and their earnings, as I've said multiple times, it does not matter nearly as much, I could almost say at all, but nearly as much what their earnings were versus the estimates. They beat earnings, let me highlight that again. They beat earnings by nearly 3 times analyst expectations. And what do? We went from 375 peak price pre-close all the way down to right now 273. So what was bad in going into earnings got worse and accelerated through the low. We tried a little spike in the middle of the night, but we're opening even lower than what it was, how bad it was last night. So when you're looking at all this data and you say, well, wait a minute, you beat earnings by 3 times. Yep. And you've gone from 375 to 274. Yep. You're down nearly 25%. Yes. And you beat earnings. Yes. So does it really matter what the analysts thought? Well, probably a little bit less because they did this before earnings. So the market's expectations are a big part of it. And then the other part of it is guidance. When we guide lower, when we say, hey, remember how we thought we were going to make all this money? We're not going to make as much. The market is always pricing in the future with a little bit of discount of uncertainty. And the guidance that Palo Alto gave, they cut earnings per share guidance by 20%. But what is Palo Alto? Palo Alto is cloud services. Palo Alto is, I think they have data centers as well. Let's pull it up really quick. Let's see. Let's go to the Analyze tab, go to Fundamentals, just to make sure. I think they do have data centers on here. And we're going to take a global security, cybersecurity provider, company, cybersecurity platform services, help secure enterprise users, networks, clouds, endpoints by delivering cybersecurity backed by artificial intelligence on automation. Hey, they said AI. That's a good reason to go up. All right. So cybersecurity, primarily the cloud services that they provide. They don't have it broken out, the little bar that shows how much goes to each thing, but they have cloud native applications, CNAP, Prisma Cloud, and other cloud environments. So just all cloud. But they've always have been considered to be best in class, the one and only, really. And we used to trade Palo Alto way back in the early 2000s as well. They're the big one. And so as we see the pressure, look at this. There we are, down 25% on the open. And as we price in more, the market, all the people that had trades here, remember, they had stop losses anywhere up here, 10%, 15%, 20%. If you had a 20% stop loss, it's getting triggered right now, at this very moment. And as we're looking at that continue to sell off, the pressure is to the downside. And the pressure is going to trigger more selling and push this lower and lower. And again, what did they do? They said, we beat earnings by 3 times. But that's not enough. We beat earnings by 3 times, but we are guiding you and telling you that we are expecting a lot worse in the future. That we are not going to have the kind of growth in earnings in the future. And so that downgrade, all the price that pushed it up to 375 was projecting into the future. When you're saying, hey, you're going to make this much, we're going to give you a multiple, and we're going to price in X number of years of that kind of trend and process. Well, we can see we're pushing lower and lower here. And even though that's not a big move in that little candle, it's still a 1% drop since open. In the last 60 seconds, we've dropped another 1%. We opened at 275, and we're currently at 269. So now we're down 3% from the open and 27% from the close. And from the peak, 30-some. So Palo Alto is definitely putting the pressure on. And if we're going to guide lower with Palo Alto, who is cloud-based servicing and cybersecurity and AI, we say AI, that must mean something. What's that going to do with the Nasdaq? Nasdaq has already sold off. It's here at fair price, balancing through here. It's trying to bounce and recover. You are going to have a significant attempt right through here at fair price. We just created a higher high, lower low, and we're trying again. We're going to attempt to push this back up, all the way back up to 17,600. The market's going to try. But if it cannot sustain a close above 17,525, if it can't get above that volume-weighted selling pressure that we've built overnight, then we have more likely downside as we catch up to the stop losses triggering on Palo Alto. Now, there's something else that's in this group, in this NASDAQ group, that I think we've kind of forgot. Yeah, just put exactly, Christian. Just put AI in the description. Roku beat on bottom of guided higher and got slammed 25%. It's the guidance. It doesn't matter what you've done for me lately even. What are you going to do for me in the future? That's what people care about. Thanks, Christian. Yeah, firewalls. But we call it cybersecurity now, right? Cybersecurity and AI. Did I say AI? AI. And so Roku needs to say, and we'll help pick your favorite shows through AI. AI. Yeah, and Tim says the forecast was dismal, though. That's what it is. It's always going to be not what everybody says. What have you done for me lately? Nope. It's not what have you done for me lately. Did you do what we thought you were going to do? Nope. We already priced that in. We already priced in the expected prices. It's how did you perform with what we thought, not what the analysts thought, with what we thought you were going to do, and what do we think you're going to do for us in the future? Remember when Tesla was at its peak? What do we have? 1,000 PE, 1,000 price to earnings. It was ridiculous, and that's what I want to talk about next. So when we're looking at this, struggling here, where? Right at fair price. Battle, right at fair price. And so as we're looking at what else do we know? We have Tesla, and at one point they had a PE of nearly 1,000. I think it was actually over 1,000 if I remember. Tesla was always pricing in the future, but what that PE ratio, sheesh, I'm having a hard time typing. What that PE ratio did is told us that we're pricing in all the future. And theoretically, we're pricing in 1,000 years of price to earnings ratios. We think you're going to trade for 1,000 years like this. But what do they do is say, you get a multiple. We're going to let you trade at X times your earnings. And we're also going to give you X number of years of growth. And so it's really growth-based, projection-based, earnings-based. But the PE ratio of 1,000 was nearly 25 to 50 times greater than other tech stocks. And Tesla is a tech stock. It's not, or it was anyway. It's not treated the same as a automotive stock at all. Now Tesla had a major lower high, lower low through here. We just created higher lows on the open. I should have got here faster. Created a higher low on the open. This is a break of trend. See how we created higher highs, higher lows, higher highs, higher lows, and as soon as we broke through 194, this says uptrend, and it's probably going to go try to check 197.65. 197.33. Just yesterday's open in essence. And that's going to say, okay, we just created a retest here. We're going to undo that, basically what the Nasdaq did yesterday with its key levels, but the Tesla could not. So normally I day trade in the futures. I can do some of that here as well. We can do that. Let's give it a second to shake out, and we can do some. Yeah, let's go. I can do that right now. Let's shift gears here in just a second, and we'll do some of the scalping or the day trading off futures here in just a minute. So notice we pushed up that shadow, that open candle. Let's see, and I couldn't see where the open was. Let's see. Oh, that is the open. Yesterday's open, 196.16. What was the high that we just put in? 196.11. So that may have been it for Tesla. And by the way, Tesla got dethroned by Eli Lilly as far as kind of being the Magnificent Seven. We'll go talk about healthcare and Eli Lilly in a minute. But yeah, as far as trading this on opens, you have to be careful with trading opens because a lot of times you get these little head fakes. If I were trading this live, and I'd have to open up my futures account with TradeOf8 to do that. And we'll see if we get something set up. Consider if you want to. I usually trade 1,600 ticks on the Nasdaq, and the open is fine. But if you want to slow it down to 3,200, just so that you're not getting head faked on the open, I think it's a great way to go. I'm the new Don. Hey, them's fighting words, Mark. I hope he's listening, sitting in his lounger. Anyway, so when we see this kind of open, when we have the pressure to the downside, remember we still have pressure down on Palo Alto. We still have pressure weighing on the markets, and we know that we're going to likely price in some more bearishness into the tech sector, but it's going to try the best it can to defend. I would be using the short-term candles here and say, look, we have a one candle reversal in a downtrend, and the one candle reversal, for those of you that don't know what I'm doing there, the one candle reversal is a system that I built based off larger than normal single candles being erased by larger than normal single candles. And what I'm doing is I'm creating a micro price pattern. And so this candle is larger than normal, bright green, as you can see down here. It's harder to see over here, but bright green. And so if we trade below the low of this candle is 1975 range, but the open to close is what I use. The open is 89.25, the close is 05.50. And so we're looking at about, let's just call it 16 points. So if it breaks through the low of this candle and erases all the buyers that stepped in here, creating this very bullish candle, then it should reverse that same distance, and usually twice as much. So I measure that and say from the open to the close, if it breaks out, and I even give myself some breakout breathing room. If it breaks out through here and breaks through this low of 84.50, then I would go short, and I'd be looking for it to go 16 twice, which means I'm looking for 32-point target if it breaks down. And then I'd place the stop up here at 500 from the roundie. I don't have any divergences. I don't have anything getting overextended. And oftentimes I let it kind of shake out this first 15 minutes or so because you get these spikes. Spike down, spike up. Doesn't mean those are untradeable. Just to give you a sense of where we were at. I don't have any Bollinger Band breakouts here either. But I'd be going from the dot to the close to the open on this big green candle. And what did it do? It broke out. And what did it do? It went down and tagged the 200% level. That would have been a winning one candle reversal trade right at 650 is the candle, and it broke down at 716. So even pre-open, this big red candle on the open went up here and closed past the 50. Even though it didn't get to the target, any close past 50 is a risk off. So the first trade would have been a win. Second trade would have been break even. Third trade would have been off of this candle. And it's not really giving us any big candles right now. See, we're balanced. Like we said right before the open, that 50% level is balance. We're weak, but balanced at this 50% level. We're trying to recover, but it's struggling. And we're seeing it balance at the 50 and stay below that VWAP. This breakout didn't close past the 50, so this would have been one that we would have had to stop at. So we would have had a winner that gave us 2 times, a break even, and a loser that lost us 1 times. Net, net, positive, positive. Thank you, Timothy. I was looking for that. Good morning, Marshall. Did you do both of those? Did you do one of them? Did you do none of them? Oh, by the way, this would have been the trigger. I was reading chat and didn't even look. This would have been 2 reasons to take this trade short. 1 counter reversal breakout. You'd be targeting all the way down here. As I said, 2 reasons. It's actually not. We didn't trigger the dot. So this would be a 1 candle reversal short right about there at 85. We'd be looking for it to go down to 53. And you'd put your stop right about 501. I didn't anchor it perfect, but 502. Probably 502.25 because you'd round up 1 tick on all those. But the goal again would be to see it come all the way down here to 53. So we're looking to make possibly 32 points on that move. But that would be the short. Ah, thanks, Ivan. Ivan. So that's the setup. That's the bearish move through there. And so we can come back and look at this. It's not moving super fast. I'm surprised at actually how slow this is building our 3,200 tick candles right now. Usually during an open, you're going to get a new candle about every minute as far as on 3,200, maybe even every 2 minutes. But when we start in that first open, there's one that took 1 minute. And there's that trade. Should have had my futures account open because that was the trade. So this would be a close past the 50. So at this point, I would take risk off. Just eliminate risk, move your stop to here. Let it go, and the target is down here at 53. And if we would have taken that trade right now, back here, on the breakout, we would have no risk on the table. We'd have another 1 candle reversal as soon as this candle closes if we don't reach our target down here at 53. But this is all the pressure building to the downside. If we know that Palo Alto is going to guide lower, guide lower, guide lower, and they're saying our customers' orders are going to be lower and lower and lower, that means all the customers people thought they were going to get from AI. And by the way, I'd move my stop now down to 78, 78.50, right above that 1 candle reversal here, and just limit out right here. If it can get there, we're real close. So we'd be getting 50% of the trade no matter what. And we're just looking for it to tag that 53. If it reverses all the way up through here, then we'll get out about 78, which means you would make about 7 points, but the expectation is really to see it drop down to 53. All right, let me do this. You took the non-directional. Okay, let's take a look at the double calendar then. And we also, just as a reminder, yeah, let me walk you through a couple things on this. So Mitch asks, how many points is considered a large candle? My rules are based off each instrument independently. And so what it's doing is looking for an ATR, a normal range, in essence, an ATR, and then it's looking for the body to be more than 50%. And during a highly volatile day, or even time frame, I would go into these candles to the study, and I'll just show you this script, and it's in the shared studies page. If you go into that study, you'll see it says 80% of normal for an ATR, so it's got to be at least 80% or bigger, and 50% of the body, or the range, has to be body. When I see that there's more volatility or that I want to get extra confirmation, I will go 90% or 100% of ATR, meaning it's got to be a full normal range, and 55 to 60% on the body, meaning that the open to close has to be 55% of the entire range, which is near the top side of the average. And if you click on that, it's just going to get rid of a few less strong candles. This one's still one, this is still one, this is still one. But it's just a percentage. And my rule for intraday scalping is I want the distance between the first candle that sets up, and by the way, we're about to hit our target. I want to see that I'm risking about $200 for a full contract, $20 for a micro. And so on the Nasdaq, that means I'm looking for about a 10-point body. So I can risk 200 to make 400. On the ES, when the points are $50 a point, I'm looking for 4 points for the ES, 4 points for the Russell. The biggest part of that is that I want to have the ability to adjust risk, that it's not going to be one candle hitting targets and stops, one candle hitting targets and stops over and over and over. I want to see that I have room, like we just did here. Tighten stop to break even. One candle reversal, tighten stop. We just hit our target, and you would have limited out, and that trade right there, even though it's during the open, it was risk managed, risk eliminated, full target, and it would have paid you out about 31 points. 31 points, and for some, that's day done. 31 points, you could be day done, and here we are less than 15 minutes after. Well, we're 17 minutes after the open, but your trigger happened at 7:40. You hit your target at 7:46. So in 6 minutes, you hit 31 points, and you could be done. Let's go look at that Toll Brothers. Hang on. Have to put it back in. And by the way, remember what I said. If you're looking at doing the bearish directional, do not take that trade until the last half hour or so. Look what we did. We went from way down here, and we recovered all the way back up here. We were pointing all the way down here when we were talking early in the morning. It recovered. It closed up. We had a 3-point move up to the top side from the open and closed up. So reality is we would have been possibly even looking for a bullish directional move. by the end of the day. You don't want to do directional trades until the end of the day. If you're going to do the non-directional trades, you can get away with doing that earlier in the day, even if you're not sure which way it's going to go. But this was pricing in a bullish directional move, and that would have just blown the doors off there, and we'd be trying to roll out our short side into the long side to get even more money, but your short put vertical would have paid for most of that trade. So we would have been bullish directional trade in Toll Brothers if we would have waited towards the last half hour of the day. You'd have been trading from 102 to 103.70. That's more than $1 more than the strike width. You'd have been targeting up about 105, and that would have been the setup. Now, as far as the existing one, if you're looking at this as a double calendar, how are we looking as far as the implied volatility? If we're looking at that from the 13 cents was the setup, let me bring this over so you can see. I'm sorry, the 93 cents was the setup. We didn't need that directional trade at all. This would have been the trade, right? So we're looking at the 107 is our focal point because the 107 has a short call and a long call. The implied volatility, as you can see, we've shot all the way up here, the $93. Remember the $93, and we'll unlock all of this. So our implied volatility, did we drop? We did. The put still is way out of the money now, so it's a little bit off center from where it should be. But we did drop down to about where we thought, into the 40s. There's 54, 47, and the stock and the long position for the call is now matching. Next week is matching at 37, 36, almost exactly what we would expect. As we're looking at this and applied volatility through here, today, this is our potential reward. Notice we're up here, down here, up here, down here. So where's the benefit? For spending $93 and having it be up here, well, we're winning 25. Is that great? But the 107, if we get the rest of the implied volatility out, we're talking about another 10% on the short call to go away. If we're looking at that 107, a little bit more specifically, the 107 for next week, we're deep in the money. The 107 for the front week still has that 49% implied volatility that will drop all the way down to 38. By Friday, it will go to 0, but Friday's close, it'll be 0. But right now, if we're at 109.27 and this is at 107, we have about $1 of time decay or volatility and $2 here. So we have the potential, if it just stays here, we have the potential to make another $100 on that $95 risk. If we drift a little bit lower, since we're at 109.28 and we are pulling back a little bit off the highs, if we go back a little bit lower and closer to the 107, we'll have an even bigger return. The goal is to see a little bit more of that time decay come out, and it'll come out as we go about an hour or two in the day. This should get closer to the intrinsic value and less extrinsic, at which point you would consider buying this back 340, and it might be 3, it might be 280. And since you own the 107, what I would be looking for is buying this back. Let me just mark it with my magic marker here. I would look to buy that back for 330 and sell the 108 for 330. And what I'm really hoping is that this drops down to about $3 or even $2.70, and we lose about a third to half of that implied volatility by the time the volatility comes out of this front week. And so we might be able to pay $3 and sell the 108 for 350. And if I can do that, then I'm going to collect another 50 cents credit and turn it into a dollar vertical. So if I paid 93 cents for it and I can then collect 50 cents on it, I'd be at 43 cents. I could roll it into next week and I would have paid 43 cents to make $57 and turn this into a dollar wide spread. But right now you can also close it. And if you were to close it with that extra 20-30 cents in here, the 107 versus, or sorry, the 350 at the 107 strike versus the $4 at the 107 strike. There's 50 cents in there. 50 cents of profit in that one, if you get the vol squeeze. But we're still in the first half hour, so I would say leave it alone. Let it breathe out. You have a calendar. There's no harm on that. You can take your time. Let it breathe out. Let it do what it's going to do. And it still has some implied volatility to get out today, let alone by expiration. So Toll Brothers is working out. It just still has a little bit of implied volatility that you want to get off the table first. So, yeah, you're only up 20, 30 points, or $20 maybe right now, but I think you should be up $50 by the end of the day. You should get higher than 50% return on risk. It's still in the first hour. The first hour, you still have a lot of implied volatility in that trade that has to come off. Caterpillar hit 50% for last week. Good job. Nasdaq just hit the daily expected move. Yeah, I mean, if you're uncomfortable with it, let's just say that you paid $90 so I can do my easy math. If you can get $30 out of it in the next half hour, and you're saying, look, I'm just not comfortable with letting it continue to get that volatility out, there's nothing wrong with that. I don't have a real issue with it. But there's still 11% implied volatility that's going to disappear in the next 2 days. But I don't want you holding it into expiration, because then it's too hard to get out of the trade. The spreads get too wide, and they get you that way. But as far as this, if you say, look, I can make $30 on a $90 investment, 30% for a trade that took me 10 minutes to look at. If I can make 30% return on risk, and it's just that implied volatility, and you have a zero delta, doesn't matter that it's how high it is right now, just let it work for you. Give it another half hour, give it another hour. When the market settles down and Toll Brothers decides where it's going to be, even if it's way up here, your implied volatility will continue to fade as they can see where they need to be. Now, Toll Brothers, again, kind of like what we saw in the others, doesn't matter what this number was. I don't even know how it came in. If we're looking at the implied volatility, we saw that they're pricing in a big move, and we're above that big move, and we beat expectations. So Palo Alto beats expectations by 3 times, gets clobbered 30%. Toll Brothers beats expectations by about 1/3 and goes to the moon. And it's up about 6%. All right. And we can do some other ones today. Does parabolic SAR affect these trades? On which one? On PD? Are we talking about the intraday scalp, or are you talking about earnings? Let me know. Exactly, Paulo. Win's a win. Good job. I do want to look at crude as well, Eric. That's a good idea, and we can talk a little bit about intraday trading on crude, because the same rules apply on all futures for me. It's just a matter of determining what size of tick candle you're going to trade, or just trade the 15 minutes or a time-based one. You don't have to do the other either. But as we look at crude, when we cleared out that 76.66 that I was seeing us get stuck in, we broke out, created a higher low, broke out, and now we're at these higher levels, and we're toying with 79 as kind of 79.80. So maybe we go 80, 80 and 70 as our potential new range. But, you know, today's little bounce is just trading back to the yesterday's same levels. Let's see, where am I at? There we go. I don't have my charts linked the same. All right. By the way, yesterday's monkey bars did an excellent job defining the ranges that the crude prices were going to go to. today crude is expected to be overbought here and fair price here. Almost identical to the Nasdaq, almost identical to the S&P. And so when we see them trading back to their fair price, overbought, fair price, we've got downward pressure, but we're finding balance. And that's a great time to create a support level. Excuse me. Suddenly got a frog in my throat. All right. So as we're looking at this, this is the overbought area for crude. Crude is near this previous resistance. I have multiple days here. I'm only focused on really on this day from the dotted line. It's just sometimes we don't have enough candles to trade here. I don't trade 3,200 on crude. And so your question is, how big is a big enough candle? The indicator lights it up if it's, again, about full range of an ATR and more than half the body is, or half the range is body. But this choosing the right tick size to make that body count, those rules are the same on time. It's large enough every time. It's more than half the range. It has to be body. It has to be a normal size candle or bigger to be able to turn that into an indication that it's time to trade. Over here on crude, 3,200 is too big. I don't need it to be that big. I'm looking for this to be about $200 risk on the body. And if I'm looking at that $200 risk on the body, that's 20 cents. So I'm looking at these ranges and saying, show me ranges that are about 20 cents or more. And this is 21 cents, 30 cents. These large candles, the ones that are bright red, bright green, that's 34 cents. So I don't need to wait 3,200 ticks. Oftentimes I'm trading crude and the euro US dollar at 512, which this says wait till you get 512 trades. If I need to slow it down to 1,600, we can. But this is where I'd start. And if we look at crude, we had a bearish trade here, one candle reversal. We had a Bollinger Band breakout. It already ran the distance. We have these potential trades. Now here we are in the middle. If it can break through the top, I will be going bullish above 77.35. Or if it can break the Bollinger Band, I'll go short somewhere near 77. We'll see where that one goes. Now I do want to talk a couple of other things here. We've got about another half hour. Just reading here. Okay. So I commented a few minutes ago, that Tesla, which is from the long term, Tesla's having a lovely bounce today. But when we're looking at this, Tesla has lost a ton of its value. We can see that it's gone from that 1,000 PE ratio, and just in the last 6 months, we've gone from 278, call it 300 nearly, all the way down to 175. We've taken a 40% haircut on Tesla as far as making lower highs, lower lows, lower highs, lower lows. Today's having a good day. Today could be setting up for a Bollinger Band breakout to the top side. And great. Now it's tech that really doesn't have to worry nearly as much about cloud. So cloud's struggling and AI is struggling. Even though Tesla has a lot of AI, that's what the whole auto drive thing is trying to look at the program safety in there. And we'll see more of that. But we just hit a record low. And we bounced back up. Their PE ratio has gone from a couple of years ago where we were talking in the thousands. And now our PE ratio is all the way down to 46. 46. That's normal for a tech stock. And yes, we should still treat Tesla as a tech stock. And it's actually cheap when we look at the other tech stocks in the Magnificent Seven. But one of the things we talked about yesterday is we talked about who was the top performing sectors, the top three, who were the ones we were seeing shift and change positions. And the very top was healthcare. And we also saw the shift in consumer staples versus consumer discretionary. So all the way up here at the top, and this is some longer term view, this is the annual view, we've tried to break out through the 120. Look at that recovery. Look at that growth. It's not just a retest of the highs. It's not like the S&P retesting the previous highs. we've gone from 122 up to 144 on an index, a sector, and we've pushed to new highs. And this is a massive swing. 20-some percent since October, pushing all the way up. But the big one that kind of dethroned Tesla from the Magnificent Seven is Eli Lilly. So Eli Lilly has been acting like the other Magnificent Seven. It's been acting kind of like a meme stock. We see higher highs, higher lows. This is mainly, I forgot the brand name of their weight loss drug. Everybody's doing the inject you and then you lose all the weight and away you go. So no more pills. Now we're going to inject you and you're going to lose the weight. So there you go. And we already had expectations and earnings. They've just been knocking the cover off the ball. When you go from 10-cent earnings to 250 earnings on a new drug, we're pricing in the future. So the fact that we hit this high and pulled back, this could be setting up in an area that we want to continue the trend. I don't see any reason to think that we're going to reverse too sharply. Yes, we maybe overshot the price, but we're still creating higher highs, higher lows, higher highs, higher lows. And if we look at the channel that went into Eli Lilly, and knowing that the entire health sector is the top performing sector over the last quarter, and we're looking at the closes, I'm going to skip that one little outlier. Oh, come on, anchor. There we go. Oh, anchor. Anchor. Butter your bacon, boy. All right, there we go. Perfect. Except I want anchor. Click. There we go. Extend that to the right. This channel that led into this breakout was also the gap to that area. Anything above this level through here, say 724, I'd be looking for a bounce and a buy. This gap down close up is not necessarily it. The gap down close up will probably want to fill the gap at 756, but I'm going to see if we get a little bit more of a pullback, a little sideways move, and this is my prediction. And Corey and I joke about predictions. I predict all the time, and he doesn't like the term prediction, so I've one-upped it and said, okay, I'm going to prophesy. So I'm going to prophesy that Eli Lilly is probably going to pull back and retest 730. At that point, I would be looking for a buy opportunity. And if we look at where these intersect, probably a buy opportunity by Monday, down near 730 again. That will give you another opportunity to buy Eli Lilly and trade it at least up to 755, but probably up to this area that we engulfed. Using that one candle reversal concept again, we're talking 772 and 780. So if we bounce at 730 and go to 780 and we get $50 on that, great. But how many of you are going to go out and buy 100 shares at $730 and say, I'm going to put $73,000 on an overbought stock? Anyone going to rush out and do that? $73,000 on a stock that's over Ozempic. Thank you. Yeah, we're probably not going to go rushing out and saying, I do want to spend $73,000 on an overbought stock that can have a single day that will give back 5% of my $73,000. And so instead, what does everybody do? They create the monster. And the monster is, they say, hey, I think that this is a good place to buy, and we're going to go back up to here. So I'm going to buy an out-of-the-money call. And if I buy an out-of-the-money call up here at 780, and if I get to in the money, my cost is minimal. And if it gets up there, I'm going to go bullish. And I'm going to stay in it as I go in the money. But if they're buying the calls, long calls, this goes back to the whole thing about why we get this gamma squeeze. If we can see it drop down here and we say, well, I'm going to buy a 780 call or a 770 call, a 750 call. And if I buy the out-of-the-money call on Eli Lilly at a support level, as long as it doesn't break through that level, and look at that, we're fading back down. 730 is going to be retested. If I can buy it down there, and that $50 out-of-the-money call what happens is all the long calls, everybody else that joins me in that, and we buy a cheap out of the money call for the potential of having something that costs next to nothing go to in the money on a highly volatile stock. What happens? We can stay with that trade and let it go and go and go, but we don't. We're going to get benefited from that because all of our long calls that we're buying require that the market makers that selling us those calls are short the calls, end up buying long stock to offset their delta, and we create the gamma squeeze. All right. And yes, I think you can reduce your risk, reduce your volatility, Kenman, by just doing a short put spread on XLV. Absolutely. Absolutely. It's the top performing sector for the quarter. It's holding up there. Despite the sell-off that we got yesterday, it's still holding up the entire sector. Hang on, let me get back to the chat. Yeah, I see Johnny's lurking about. Hey, Johnny, you lost your stripes. But Johnny and I even talked about, both of us were talking about silver way back when, and I was just saying go long silver, short gold, and he loved the silver trade. We talked about that at the close, what, 4 weeks ago? Good trade. All right. Good job, Johnny. And all those that were participating in that. All right, I think that was all the questions up to that point. So, Nvidia has earnings tomorrow. Can we bundle tomorrow? Expected move 74. That's what it's going to be a little tricky, but let's run the numbers. Let's read the numbers, shall we? Let's talk about this idea of an earnings trade on the Hydra. This is the unkillable beast, or at least so we thought. Gap down, trying to recover. Kind of looks like some of the other things we've seen. Not recovering that much. Is playing with these channels. I still like the channel, by the way. I think it's going to go back to probably that 663, 664, where the gap is and where the channel meet. Now, if we're looking at this, and you're saying, well, when is earnings? Earnings say that it's aftermarket today. So if it's aftermarket today, if we were using this chart, we'd say open of day 1 to close of day 2. That would say go bearish, because clearly we're more than $1. Clearly we're more than the strike width when it's 719 down to 681. So this would be screaming at us, do a bearish trade. My concern is I don't like gap down, close up, because it tells me that the market is struggling with this number. So if you're going to take a directional trade on this, I think you'd have to wait towards the end of the day. It has to be, for me, it has to be red. And I do think I agree. This is going to be dangerous. But here's the thing: is it really dangerous? Is it? Let's run the numbers. So let's ignore the directional trade because I don't trust that gap down close up yet. If we're at the end of the day, we might be able to pull something off, but directionally. But as it sits, I don't like that. So instead, I'm going to look over here and say we have a 95% implied volatility for next week and 169% for this week. Half of 95 is 42, 43, something like that. So we're really well above 50% higher than the normal implied volatility. And I think when Brandon was sharing it with you, he's had 60% or something. I just do 50 to make it fast, just so I can know if I'm in the range. But you could say 60%, and that's a better number, but 50%, I'm willing to go as low as 50% higher. So anything above about 138, 139 is good. We're at 169 as far as the implied volatility. And so 50% more of the second week or the back week. If we're looking at this and saying, look at the expected move, $73. Next week's expected move, $83. if we were going to look at buying a delta near 25. $5 away. Oops, I need even more. I'm looking at 625. Our current price is 680. So if I'm looking at 625, our current price is 680, we're talking about a difference of 55 or 65 points, right? We're expecting to touch 73. So I would say let's err on the size of a little bit bigger move and go to the 23. So if I'm going from 680 to 720, now I've got 60 points, and I'm still inside that range. Let's go out a little bit further. Let's go to the 20 delta. Let's go to 615. If I'm buying the 615 put, and we have an expected move of the front week at 73, the 615 put has a delta of 21. And remember, we want it to go touch it. We don't want to go so far out that we're not going to touch it. We want to be close, though. So if we're going to 615, we want to have that chance to have the long position still have money going into next week. We want it to get there. So 615 from 680, again, current price roughly 681. It's moving around. Now we're talking about 65 versus 73. Let's work with that. Okay, let's do 20 deltas. We are pricing in a lot of volatility. So we're going to buy the 615 and sell the 615. And they're going to make this as hard as possible on us. There we go. Sell the 615. We'll do the same thing on the calls. We're going to go out to a delta near 20. On the long side here. And we were at a 21 delta. But see, if we go all the way to a 22 delta, that's $100. We're not equidistant. If we go to the 24 delta, that's $770. That's $90. We're still not. We maybe let's go with the 765. 765 versus 680 still has us up 85 points. So this is a much further target on the upside. We're pricing in a recovery for Nvidia. 765. The risk is to the upside. Now, this is pretty expensive. It's 640. For a double calendar, this is 640. If I analyze the trade here, like I've done many of these before, we're going to take the implied volatility of the front week and collapse it down. Would you risk $640 for, and maybe that we could stop right there. Would you risk $640 on a singular event? And the answer might be nope. But if we're looking at this 158 down to 90, we'll drop that down. I'm just going to go 60 points. There's going to be a lot of volatility that comes out. So we'll go 158 to, oh, I was looking at the wrong one. We need to go 70. We're going to bring that down to 89 or lower. And we're going to take the 176 and turn it to 95. Which means we're going to drop that 80. And then we're going to take the back week, 89 and 95, and turn it into 65. I would repeat what I've said before. Probably wait a little bit closer to the end of the day to actually execute this trade. But you could start working that order sooner than later if you really wanted to get in this trade and try to get a better price. We're going to go 95 to 65. That's down 30. So I'm crushing the front week to match the back week, and I'm taking the back week and saying go down to the stock. So we're giving up a lot of implied volatility on the back week too, and we're hoping that we don't go and collapse the circus tent in the middle. This one did collapse down. It's not losing, but it's close to that zero. The idea would be that we're going to see a break-even trade. I'm just setting slices to break even. You can't see that off the chart there. And this is telling us we have a 99% probability of success, meaning not lose. Even though it says we're risking 638, it says you have a 99% probability that you're not going to lose. The standard deviation and the sides we are selling outside, on the call side, outside the expected move. We're selling roughly the expected move, a little bit outside here too. And so we're saying we would have to go from 680 down to 580, or from 680 up to 840 before we lose. $110 on a 680 stock, if this is the place. So I think this is a reasonable trade to take. It is a lot of expense, especially when there's a very little profit here. Now, if we can hit the target, awesome. We could see potentially $2,000 or maybe $1,500. I would run my calculation based off half of the lower peak, which would be about $750. Would I risk $638 to make $750? Yes, especially if I have a 1% chance of losing. I think that one looks fine, but it is a lot of exposure. So Photo Guy says, you know, we could use semiconductors, SMH, as a substitute if we're getting enough implied volatility in there. Are we seeing the same kind of skew? So as far as a trade, yes. As far as an earnings trade, do we have enough implied volatility? Yeah, we actually do. 44, half of 44 is 22, 44 to 22. If you believe all this implied volatility in the front week is because of Nvidia, which you should, then you're saying, hey, I can trade here and distribute some of my risk out on a stock that's trading at 1/6 the cost, or 1/3 the cost. So you could do the same thing here and say, let's do a double calendar on SMH. I don't need all these strikes. And you could benefit from the same collapse of implied volatility, because we're looking for that 44 and 73 to get closer together. It's all about the vol crush. So we only need this to be at 66. We're at 73. So yeah, this is a good example. Good call there, Paul. As long as the implied Photo Guy, whoever, I'm sorry, I scrolled and now I can't see who said it. So whoever said that. Yes, Photo Guy. So good job. Not good job for you, Paul. Bad job. Oh, good call, Photo Guy. Just didn't want to give your credit to Paul. Paul has to earn his credit. So earn your credit there, Paul. Don is off this week, yeah. So I'll be doing the open all week long. And now you're saying, dang it, he's not nice. Okay, so let's run the numbers here. I like it. I like the idea. And did I say Nvidia? Yes. Gold star for Photo Guy. I accidentally put this gold star on Paul's forehead and had to go peel it off his forehead, you know, picking it off with a fingernail. All right. So here we go. Delta near 25. Let's go with the 188. And we really should check the open interest on this, but we're just going to run the numbers. 188, 188. On the call side, let's go with the 205 and 205. Now remember, we do kind of want to tag this. So for 195, we're going to 205. We're talking about a $10 move, and we're at 9. Good. We're going to get pretty close. We could even bring it in a little tighter if we wanted to, but I think this is where we start. Let's analyze the trade. Looks amazing. looks like it's going to be just a phenomenal trade, but we need to do a couple things here. This says if we hold this into, they always set it to Saturday, so you know it's expired. There you go. This says 99% probability that you're not going to lose. It looks like you're going to make all this money. Would you risk $138 to make 162? Well, of course you would. But we've got to crush out the volatility. So we're going to take 71, match it to 42, and 70 and match it to 41. Oh, we have more than one Paul here, too. You can choose which Paul needs to give up your gold star. Let's go 29 here. And we're going to go 70 down to 41. 42 down to 33. That's just 9. And so I'm crushing the front week to the back week's volatility. And I'm crushing the back week down to match the stock. 41 to 33. And we're just going to make that, knowing that after earnings, the back week will drift to the stock. Now, this is good. This is okay. This is, I mean, if we could ever have it be really high in the middle, it's great. As long as the circus tent does not collapse in the middle. People suffocate in the circus tent when it collapses. We want that to stay above the ground, and so for a safe exit. So holding that into expiration, if we get all that vol crush, we're going to be looking to make at least 30 bucks. Great. Would you risk $138 to make 30 if you had a 99% probability of success? Now, I did crush out the volatility, so we need to move this in and say it's not quite 99%. But we could go about 2 standard deviations, and it says 98%. So about 96% probability, 2 standard deviations. So as we're looking at this, I would be looking at this and say, if you would you risk $138 to make 30? If that's the case, you have to be right about 78% of the time, maybe 80% of the time. It says you're going to be right 97% of the time. I like it. I would work that order. I'd probably try to get $1.30 or less, and I'd just start working that order throughout the day. And I think you have the luxury of that you can let this do whatever it's going to do. I'm going to paste that one that we can review tomorrow. Yeah, sadly, Don, if Nvidia guidance is lower and Nvidia gets knocked down, Don doesn't get to do a victory lap. I get Don's gold star, just like what we were just talking about a minute ago. I'm going to get Don's gold star that would have been put on his forehead. All right. Yeah, you know. And if you look at the Nvidia, $600, it is a lot. $600 for a kind of a flip of the coin as being an event-based or an event-driven trade is kind of sketchy. And so I like it. I do appreciate Photo Guy bringing our attention that the implied volatility was high enough in the ETF, which usually doesn't happen. So good job on that. That's kind of the one we'll run with, and that's where we're going to pause today. I still need to get to the discussion of consumer staples and healthcare. Those are some of the ones I'm paying very close attention to that I'm going to be leaning into over the next few days and few weeks. But my time is coming to an end. And now the time is near. And Jeff Bierman, the professor, will be taking you into the February 2024 TheoTRADE member email grab bag. So the professor will be doing his grab bag, answering questions. We will check back with shaking my head, or in other words, the semiconductor ETF, and we'll talk about that one tomorrow. We'll review that. Have a great day, everybody, and we'll go back and look at the earnings later. Thanks again, Photo, for catching that for us. And okay, and Gianni's still in the chat. So thanks, everybody. Have a fantastic day. And we'll talk again tomorrow. Here comes the professor.